This is Blue Nile audit evidence is the backbone of an auditor's opinion, providing the support needed to verify the accuracy and reliability of financial statements. Key methods for gathering evidence include inspection, reviewing documents, records, and physical assets, for example, invoices, contracts, inventory, observation, watching processes such as inventory counts or control procedures, inaction, inquiry, asking management and employees about financial data or internal controls, confirmation, obtaining direct verification from third parties, for example, banks or customers, recalculation, verifying mathematical accuracy, such as rechecking depreciation or inventory valuations, analytical procedures, comparing trends, ratios, or patterns to identify anomalies, performance, executing control procedures to check for effectiveness. Strong evidence must be sufficient, reliable, and relevant to support the auditor's conclusions. Let's dive into the details in our tutorials. This video is going to cover the area of gathering evidence. For us to understand the process of gathering evidence during the external audit assignment, we will need to cover which audit procedures gather evidence, the objectives, the quality of evidence required, the methods available, sampling, and conclusions made from the evidence obtained. The external audit is made up of many audit procedures or audit tests. Each test will gather evidence to help the auditor form an opinion on the financial statements. The two main areas of audit procedures are controls procedures and substantive procedures. There is a clear difference between the two, and to be successful in an exam question, which asks specifically for controls or substantive procedures, you must be confident with the differences. Control procedures are procedures which identify whether the control systems being reviewed actually work. Substantive procedures are procedures which identify material misstatements present in the financial statements. They will assist the auditor in giving the opinion whether the financial statements are true and fair. Controls procedures are carried out when an auditor is assessing the internal control systems, which relate to the financial statements. The auditor has a responsibility to identify whether the control system is strong or weak. The system should then be tested by the auditor to gather evidence to back up their conclusion. An example would be when an auditor is reviewing the payroll system. A control identified could be if the payroll system has restricted access with the use of an encrypted password. A control procedure could be, with permission from the client, try to gain access to the payroll system without knowledge of the password. This procedure would not discover a material misstatement in the financial statements, but it does test whether the control the client has told you about works effectively. Substantive procedures are carried out in the main after the controls have been assessed. The level of substantive testing will depend on how reliable the control systems are. As the more reliable the controls, the less likely there will be material misstatements. The main aim of the auditor is to identify material misstatements and ensure the financial statements are true and fair. The objective of substantive procedures is broken down into the financial statement assertions. These are completeness, rights and obligations, allocation and valuation, existence, cutoff, occurrence, classification, and accuracy. Grave Coker can assist in remembering these assertions. Every substantive test must achieve at least one assertion in its objective. These financial statement assertions are covered in more detail in another video. We have now identified the two main audit procedures, controls and substantive, discussed the differences and the objectives. Now we need to consider the quality of evidence required on an external audit. The quality of evidence is important in gaining confidence with the opinion made at the end of the audit process. ISO 500 tells us that audit procedures must be designed in such a way so that the auditor gathers sufficient appropriate evidence. So we need to understand what is sufficient and appropriate. We can define both sufficient and appropriate in relation to the auditor. Sufficient means enough evidence. So the auditor must obtain enough evidence to form an opinion. When deciding what is enough evidence, the auditor must consider the following: the risk of material misstatements identified at the planning stage, how material the balance or item is, how reliable the control systems are, the conclusions of the control tests performed previously, the size of the sample being tested, and how reliable the evidence that can be collected is. Certain balances will be able to gather enough evidence with very little effort. For example, the bank balance in the financial statements can be confirmed by gathering evidence such as the bank statements, the bank report confirming balances direct to the auditor, and the bank reconciliation, which reconciles the balance in the accounts to the bank statements. Other balances will require much more evidence to be obtained before the auditor is satisfied that it is sufficient. The term appropriate can be explained by splitting it into two areas. For evidence to be appropriate, it must be relevant and reliable. For evidence to be relevant, it must achieve the objectives. For example, evidence collected must achieve the objective of the audit procedure that gathered the evidence. If we're looking at control procedures, the evidence collected from these procedures should identify whether the control system operates effectively. If looking at substantive procedures, the evidence must achieve at least one of the financial statement assertions. Remember that these assertions help ensure the auditor can conclude whether the financial statements are true and fair. For evidence collected to be deemed reliable, it needs to be the best possible evidence that could be obtained in the circumstances. Evidence must be trusted so it can be used to form the audit opinion. Therefore, ideally, evidence should be independent, obtained directly by the auditor. If obtained from the client, then from a strong control system, written and in its original form. If auditors can obtain evidence that represents all of the points we've just mentioned, then very little else needs to be obtained for that area. There will be areas of the financial statements where this is difficult, and then more types of evidence will then need to be collected. Now we have covered the quality of evidence. We must discuss the methods available to the auditor to gather this evidence. When designing audit procedures, there are methods available that should be used by the auditor. ISO 500 gives 8 methods that can be used to design audit procedures for both controls and substantive testing. Analytical procedures. This is the comparing of data in the financial statements to gather evidence on whether there are possible misstatements. Inquiry. Talking to the client staff and management will ensure explanations are obtained to help form conclusions. Inspection. Inspecting documentation that confirms balances and transactions in the financial statements, as well as control procedures. Observation. Observing processes at the client to understand and review reliability. Recalculation. Recalculating transactions and balances for accuracy. Confirmation. Written confirmation of balances and transactions in the financial statements. And re-performance. The auditor carrying out a procedure the client has performed to see if they did it right. Each method can be used to design audit procedures, and the most appropriate method should be selected. The next area of gathering evidence is choosing the transactions which should be tested. Sampling is defined in ISO 530 as the application of audit procedures to less than 100% of items within a population of audit relevance, such that all sampling units have a chance of selection in order to provide the auditor with a reasonable basis on which to draw conclusions about the entire population. This requires auditor judgment and skill. there is always going to be an element of risk that a transaction not selected will contain a material misstatement. This is known as sampling risk. The auditor must ensure the sample size selected is sufficient enough to reduce sampling risk to an appropriate level. They must also ensure the sample chosen represents the whole population of transactions. The auditor decides on an appropriate method they should use to choose the sample to test. Again, the auditor has a number of options to choose from, and these options can be categorized into two headings: statistical sampling methods and non-statistical methods. Statistical sampling methods generally are where the auditor has not influenced selection of transactions. Random selection and probability theory are the common examples of choosing a sample in this way. Any other method would be categorized as non-statistical sampling. Methods commonly used by the auditor to select samples are random number tables, which select the transaction numbers on the list to choose; systematic selection, where the transaction is selected across the population using an even pattern, for example, every 10th balance chosen; block selection, where transactions are selected from one period in the financial year, and cutoff testing is an example of this; monetary unit selection, where the largest balances in transactions are selected to test. If mistakes are found, they are more likely to be material; and haphazard methods. These are any other methods that could be used by the auditor to select transactions. The auditor should be careful not to allow bias. Gathering evidence for the audit is critical in forming an opinion on the financial statements. Auditors identify what type of evidence is needed from the objectives. The auditor will either be gathering evidence via control procedures to test whether controls work, or via substantive procedures to test whether there are material misstatements in the financial statements. They must consider the quality of evidence that is required and available to them. This will depend on what is being reviewed, but they must ensure evidence collected is sufficient and appropriate. There are 8 methods available to them which they design their audit procedures around. And the auditor must also decide on the size of the sample transactions to test, as well as the method of selecting the sample to perform the audit procedures. Statistical or non-statistical is acceptable. Once the evidence has been gathered and the audit procedures performed, the auditor must then review what they have found. If, for example, misstatements have been found, they must decide whether these are material or not. If material, they could be misleading to the users of the accounts if they remain. The auditors therefore ask the client to amend the financial statements. If not material, they must record on a spreadsheet, often called the summary of unadjusted errors. All of these smaller errors collected could accumulate into a material misstatement, and so the spreadsheet can be reviewed at the end of the audit for evidence of this. I hope you found this video useful. Thank you for watching.